Passo ora all'inglese per introdurvi la nostra ultima relatrice. So it's a pleasure to have with us for the first time Chen Xu from Klarphos. She will talk about private opportunities in private debt. So please, Chen, the stage is yours.
Thank you very much, Bruno. Good morning, everyone. In the next few minutes, I will introduce the alternative investment asset class private debt and highlight a few key advantages that the private debt actually brings to the insurance investors. If we move to page 2, private debt, also known as private credit, is a 1.7 trillion market that initiated as a funding provider to the middle market borrowers, mostly for developed markets such as North America and Europe. Size-wise, private debt is actually at par with some of these public market peer products such as high yield and broadly syndicated loan markets. So investors increasingly allocate to private debt as an essential allocation within their alternative investment bucket or as an fixed income alternative. This is mainly due to the compelling risk-reward profile of the asset class. I would break it down into 4 main aspects to dive into in more detail, which are a return profile of the asset class, market conditions, level of diversification, and the structural features of the product. If we move to the next page, please. Private debt actually offers very attractive return to investors. Generally speaking, the investors actually get a spread pickup versus traditional fixed income products. Here, the investors are compensated for illiquidity and complexity that they invest into. And this range actually can vary in a wide band. If we take, for example, the real estate debt and that we just mentioned also in earlier presentation, and infrastructure debt, the return lies within a high single-digit range. While if we look at the corporate direct lending or asset-based lending, the return tend to be slightly higher and can reach a low double digit. And even higher, we'll see returns in opportunistic credit. Here, it would include mezzanine, stressed, distressed, special situations lending, which can help investors to achieve private equity-like returns of high teens to even maybe 20%. As you can see from the return and risk profile, private debt is actually a very versatile asset class and is able to provide highly customizable risk-reward profile investment for investors. If we move to the next page, it is very beneficial to invest into private debt in the current market environment. In a typical business cycle where you see in the diagram here, economic growth and inflation actually goes through peaks and troughs. We believe currently we're potentially in stage 1 of the economy with benign growth and falling inflation. Our in-house quantitative study indicates that private debt as is in this stage is actually a very compelling asset class to invest into, and generally they would generate higher average return than private equity or real estate. As also a tailwind to invest right now into private debt as a result of decade-long banking retrenchment on back of regulatory overhaul, and this coupled with at times a dysfunctional public market, and has made increasingly challenging for middle market borrowers to actually access funding, and private debt actually helps to fill the liquidity gap here and also prospered on back of that. Next page, please. Investors actually receive diversification benefit by investing into the asset class. There is, as mentioned, very little obligor overlap to the public market investment one might have. However, there is also an increasing trend because of the popularity of the asset class. There's an increasing trend we see that upper market borrowers increasingly tap into private debt as well to diversify their funding source. Private debt investors benefit from a very low correlation to their existing public market investments, as you can see in this chart. And then Also, that last but not least, I would like to mention there are also structural features of the private debt loans that offer very good protection for investors. There is a bilateral nature when it comes to private market lending. Therefore, private debt loans tend to actually take a floating rate format and also charge higher spread for compensation of illiquidity and complexity. Private debt loans usually would have 1 to 3 financial maintenance covenants, typically leverage and interest coverage ratio are typical ones that one would include into the covenants. The lender tends to have also more influence on back of that over borrowers and their business. As a consequence, provide investors better protection from defaults and credit losses. This is compared to over 90% of the public market debt are being covenant light. If we go to the next page, when it comes to insurance for insurance investors, private debt actually carries some key features such as self-liquidating, regular income distributing, and non-mark-to-market features that we consider are very insurance balance sheet friendly. The asset class naturally match with the liability profile of the insurance business in that way. Majority of the loans of private debt are structured unrated, which is more solvency ratio efficient than poorly rated non-investment grade debt. For example, the spread risk in SCR calculation could raise 2 times for single B rated investments versus unrated ones. If we take also private equity as an example, the equity risk, because they are viewed as equity risk type 2 assets, private equity fund potentially would receive 4 to 5 times SCR compared to the private debt fund in the example shown on this page. Worth mentioning that there's also an increasing allocation we see from the insurance companies into private debt as an asset class in various formats, such as fund-to-fund, direct placement into target funds, or forming even long-term relationship with some of the large GPs to conduct a direct on-balance sheet underwriting. We see that private debt has become an instrumental return contributor to the insurance business. To conclude, last page 7. We put a lot of thoughts into how into how we can construct an efficient private debt portfolio. We believe that evergreen is a highly efficient expression. Other aspects such as timing of investment, scale of investment, level of diversification, and longevity of the strategy design through cycle, as well as also reporting are all key elements that investors should consider, and where we actually, from our side, aim to help investors achieve in the construct of a private credit portfolio. Thank you very much.
Thank you, Chen Xu, for your presentation.